Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I'm Ryan Nauman, the market strategist here at Zephyr. I have another really fun and interesting show lined up for us today. Investing in alternatives, especially private equity, has really grown recently for numerous reasons. Product innovation has made harder to access alternatives more accessible to financial advisors as they build out those investment portfolios. Well, I'm very excited about our next guest, who is an industry expert and is here to share his great insights into the world of private equity, the impact it has on financial advisory practices, and our favorite topic, professional sports. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. I'd like to give a very warm welcome to Christopher Zook. Christopher is the founder, chairman, and chief investment officer at CAZ Investments and co-author of the award-winning book, Holy Grail of Investing. Christopher, thank you so much for coming on the show. It's such an honor to have you on. Can you please tell us a little bit more about yourself and CAZ Investments?
I'm happy to do it, and thank you for having me. These things are a lot of fun. So I've been in the investment business for about 35 years, started actually in the brokerage side of the world as an investment advisor. And after about a decade, I started my own firm, CAZ. We'll celebrate our 25th anniversary next year. Wow. We have just shy of $10 billion that's currently deployed. We're very much like the merchant banks in the early 1900s. We invest our own money, and then we open it up to our network to be able to come alongside us to invest in whatever it is that we're doing. But that is something that's a little bit unique and different about us because we've got 650 million of our own money, our shareholders, our team, and our balance sheet, my family, invested in what we're doing, which means we lead with alignment and means we're always focused on what's best for the return as opposed to any other reason. That means that we'll invest in anything, anywhere, anytime. We're a very thematic investor, and we focus exclusively on the alternative markets. We will get involved in the public markets at times, but just when there's major dislocations, like when we shorted subprime mortgages with John Paulson, or we took advantage of just very significant dislocations during COVID in certain sectors, we will get involved in the public markets. But we'll go anywhere and invest in anything at any time because that's what's going to give us the best risk reward over time.
Yeah. Christopher, it's interesting you said it. I often think about when I'm looking at mutual funds or ETFs, are the portfolio managers investing in, their own investment strategies, or are they eating their own cooking, right? And so it's interesting. And I believe like co-investing, what you offer at CAZ, it provides such a good benefit to investors, knowing that you're investing in exactly the same thing they are. You're a believer in it. So it's a good opportunity there for investors.
No, it is, because the fact that, in anything that an investment advisor, is thinking about putting into their client's portfolio, recommending to their client, depending on their business model, they know that my family is literally the first dollar in every single thing that we do, and that we're the largest investor in the vehicle. And we have all of this capital invested. Now, obviously, it doesn't guarantee it's going to work, but it means we are aligned and we're all going to win together as a team. And more than anything else, in many cases even, we don't charge management fees. We just take carried interest, and that's it, which means we are completely aligned in how the outcome is of the investment. We're not just trying to figure out what people want to do, or, the old saying, giving people a blue suit because they want a blue suit. We're saying, what is the best place for our personal capital? And I will tell you, if you look at most of the mutual funds out there, there's exceptions, obviously, but separately managed accounts, mutual funds, et cetera, in the traditional world, typically the portfolio manager has very little of their net worth invested in their own vehicles. And I think it's just really important to always, as an advisor, ask the question, don't be rude and ask them, okay, how many dollars do you have? But, you can if you want to, but that's usually a little bit of crossing the line. But ask them and say, okay, what percentage of your net worth is in your own fund?
Yeah.
And that they may be at a different stage of life. They can't do a lot, but that means they're not totally aligned with you. They're not thinking every single day about how to make you money. They're maybe thinking about those other distractions in their life as opposed to truly trying to maximize returns.
Yeah, it's interesting when, I started out in the financial advisory space too, part of the business. And we often talk, would you, as a financial advisor, offer this investment to your mom or to your grandmother, right? And obviously for younger clients, it may not work out that way, conservative and stuff, but it's something to think about. And that's exactly what you're doing.
And that's what we're trying to do is just to make sure people are thinking about the alignment. We have a saying as a firm, sometimes, where there's bad alignment, there can be very bad decisions. When there's good alignment, usually there's good decisions. And just there's some things that we can control in life. Alignment is one of those things.
Yeah, interesting. I mentioned at the top, you're a co-author of the award-winning book, Holy Grail of Investing with Tony Robbins. Why did you and Tony decide to write the book?
Tony's one of our shareholders and has just been, very meaningful to me as an individual and a big part of my life for the last 30 plus years. But when Tony bought a stake in our business in May of 2021, one of the reasons why, he wanted to do that and we wanted to have him involved was to be able to help reach a broader audience with alternative investments. And the world was already beginning to shift with a lot more access for people. And our concern was that people wouldn't actually know what they were doing when they made decisions. Or when somebody showed them something, they would just go, oh, this is the first time I've ever been able to do this. It must be a great idea.
Yeah.
No, just because you can doesn't mean you should. And so we wanted to create effectively a guide for somebody, whether or not they're an expert, as many of the people watching this are going to be experts, they'll get a lot out of the book, to somebody who knows literally nothing about alternative investments. So the first half of the book is all education. Why would you want to own a piece of a professional sports team? Why would you want to own a piece of a private asset management firm? What's private credit, secondaries, energy, real estate, etc. And then the back half of the book is all interviews with some of the true, titans of our industry that shared their path of how they became successful, how they've been able to be persistent, and also how they actually run their businesses day to day. And I'll tell you that we have so many financial advisors that use the book. They will literally give it to their client,
Okay.
and we'll be happy to give the advisors a copy to do this. Give it to their client, say, look, I need you to read this. And then we're going to have a meeting to discuss how we need to diversify your portfolio into less correlated investments. And it just makes it easier to have that conversation because it's a third party, a credible third party, and it's also written in a way that they can understand it. But we knew when the book came out, we're very, very proud that it was a New York Times #1
Yeah.
bestseller. But we knew that 90+%, just by the numbers, were not going to be qualified purchasers. And so therefore, we wanted to make sure that the rest of the folks that now are able to access alternatives for the first time, and hopefully even more in the future. Tony and I are working very closely with a number of people in the Senate to try to get a bill passed where people can take a test to become an accredited investor. It won't just be based on income and net worth. It can still apply that way, but that
Yeah.
way, if you have somebody who's a great college professor who's never made enough money, but they're really, really smart, they can take a
Yeah.
test, or somebody that's just come out of law school or whatever, and they can invest in what wealthy people can do despite the fact that they don't have enough capital. So we wanted to provide a primer, if you will, for people in the industry and the investor who now has a lot more options than they did before.
Yeah, I love that idea that you and Tony are doing because, like you said, there's a lot of really smart people out there that may not make that cutoff to be an accredited investor. And you mentioned kind of the story of my life when you said, just because you can do something doesn't mean you should. Um, I love that. But really interesting. And I think, I'm a big proponent of education and not only really educating the financial advisor, but the end investor, right? Because they need to know what they're investing in. And we all know alternatives, the benefits they have in terms of portfolio construction and modern portfolio theory. But what did those interviews, you mentioned there's interviews some of the great titans in the alternative investment space. What was there like a trend or something there that kind of connected all of them in your discussions with them?
There actually were a number of them, and what we did intentionally was we asked the same questions of all of them
Okay.
to
Yeah.
be able to see how they would respond to that question differently than the other person would. And so, there's two things that jumped out. Is one, Tony says all the time, success leaves clues. So we wanted to listen for what are those clues that lead to the success of these individuals. And then the other thing is related to, where they are different, all right, and how they approach the world differently. And the most interesting theme about all of them is they have a very systematic way in which they go about doing what they do. Whether it be Robert Smith and what he does in enterprise software, or David Golub when it comes to private credit, or Barry Sternlicht with what he does with real estate, or Bob Zorik and Will Van Lowe with what they do in energy. They have a playbook, and obviously a lot of others that we
Mhm.
mentioned that we interviewed as well. But they have a playbook that they follow. And it's really easy to teach team and to scale and investors if they know what to expect each time and they don't have surprises. So, what really resonated with me is how they all have different ways of accomplishing the objectives, but they all have very consistent ways that they do it to meet those objectives. The other thing that, I won't give any names for this one, but it was a definitive theme, which is, we asked one of the questions of what do you wish people would have told you before you started this company or took on this role, et cetera, et cetera. And I'll use a little bit of slang, and what you'll imagine won't surprise you. I'll put it that way: is the compliance department's kind of cut all this topic from the dialogue that went into the book.
Yep.
But effectively, the way we would put it is mo people, mo problems. And if you have a large growing organization, and as you want to scale as an investment advisor or whatever business line you're in, you have to think about where does culture fit? Where does hiring practices fit? Where does quarterly reviews, annual reviews, bonus pools, all those kinds of things? Most people just want to invest, or in the case of investment
Mhm.
advisors, they just want to give counsel. Well, if you're going to be a business owner, you got to think about all the other aspects, just like we would tell our client that they need to think about the other aspects of their life outside of their personal business. And so there was a real trend there of, I didn't realize that running a business was a lot harder than actually being an investor. And they obviously have adapted well and grown enormous businesses as a result of that. But those were some really interesting trends that I think everybody would benefit from.
It's interesting on that side of the business too, on the investment management for alternatives, it's very similar to whether you're a financial advisor or an portfolio manager. In fact, conviction, right? Be convicted in what you want to do, like your investment style, and be consistent, right? Whether it's your value manager, small cap, whatever your style is, have conviction and be consistent with it. And you mentioned that process. I've had a lot of conversations with people that processes people. It's very important.
Absolutely.
So I mentioned modern portfolio theory, and we've done a lot of research with Zephyr and stuff about the role alternatives have, moving the efficient frontier to the northwest corner, increasing that Sharpe ratio of a portfolio. But what impact do alternatives have on the financial advisor, on their practice?
The most interesting part about, the research that Markowitz did and everybody else is everybody gets it. You want to be diversified, move up into God's country in the top left, if you will. But the challenge is time horizon is the thing that maybe people don't realize as much as they should. So I was getting into business about the time that Markowitz won the Nobel Prize. And so I really have watched the way that MPT completely took over the industry and the way that advisors allocate capital. But what happened was from 2000 to really 1999 to
Yep.
2020, if you will, everybody said, this is great. Look at all the benefits of it, which they're right. But then what you have is a lost decade. And if you have a lost decade, then people run out of time
Yeah.
where they can't be like an endowment that's got a 50-year time horizon or a pension that's got a 50-year time horizon. They may be 10 years from retirement. Well, if those 10 years are bad, For all asset classes that they happen to own, that's a real problem. So what I will say is that most people don't understand how correlated they are. And I talk to investment advisors every single week
Yeah.
that they think they're diversified, and they actually, if we do the analysis for them, they'll have a correlation coefficient, you know, basically a cross correlation of 0.6, 0.7, 0.8. So in a year like 2022, when everything's getting kicked in the teeth,
Yeah.
this is like hiding under the desk moment for everybody. And like, okay, I don't want to have to take these phone calls. So having things in the portfolio that are truly either non-correlated, some potentially negatively correlated,
Yeah.
but at least less correlation is really powerful. So I'll give you an example and then I'll come back to your question. But we went through one of our portfolios just recently getting ready for an annual meeting. That portfolio has a cross correlation of 0.15. 0.15. It's virtually uncorrelated to everything else in it and almost totally uncorrelated. It's like 0.04 to the S&P 500. Well, that's really hard to do unless you have access to things that most people cannot get to. But for the investment advisor, what that does is it means the roller coaster ride of the client is so much less painful.
Mhm.
And everyone knows that's an advisor. The key is keeping the person in the plan that you designed for them. If they panic in March of 2009 and they bail out, well, it doesn't matter how good the plan was. They've overridden it. So if instead of having, using industry slang for a second, a 12 vol or a 14 volatility number, and you can get that number down to 4 or 5, then obviously it's a huge
Yeah.
benefit to the stickiness of the business. By the way, those people tend to add more money, they tend to stay with you longer, and they also tend to refer a lot more people because in 2022, if they're down 1 or 2 or positive 3 or 5, which is not great, but in a year like 22 is really good, they're going to say, look, my advisor protected me, and
Yeah.
you need to get with my advisor. And that's how you grow the business in an exponential way, is by doing something that other people give lip service to, but you actually be able to deliver for those clients.
Yeah. And, Christopher, in times of crisis, when diversification is needed most, sometimes it doesn't work because everyone's running to the exit, right? Especially, if you're investing in equities, bonds, international, your typical diversified portfolio, you need something else um, to help increase that diversification, smoothen out that ride. Like you said, you know, why everyone realizes, or I think most people, that private equity has a low correlation to S&P 500. But why? But why is it uncorrelated? We know that the numbers show it is, but what makes it uncorrelated to, public equities?
So I'll define it slightly differently. So two buckets there, the private equity that you specifically mentioned, and I'll comment on it, but then the private asset world.
Yeah.
Okay. So one could put professional sports into private equity. It kind of fits there. I think it's kind of growth capital. You could put it in any of those definitional buckets that you want to. Professional sports is just a great example because it has a very low correlation because virtually everything is contractual. Your media rights are going to come through no matter what. Your stadium naming rights, it doesn't matter what's happening, you're still going to get that revenue. Your
Mhm.
season ticket holders are going to still pay you. But what most people do not understand is that when you own, in North America at least, you own one team, you own 1/32nd of the league or 1/30th, depending on what
Yeah.
league it is. It's like in the NFL, these are all public numbers. So last year, the NFL generated 12.9 billion in free cash flow.
Yeah.
So if you're a 1/32nd owner of the league, your distribution, whether you're in the first place or the last place, you got a $400 million check. That's before you ever even played a game. So all of a sudden you start off with that, then you get your local media rights, your stadium naming rights, your other sponsorships, then you get, ticket sales and you sell hot dogs and pretzels and all that other kind of stuff. And then you maybe own the real estate around your stadium. It has nothing to do with your overall market environment. Now, everything has a correlation to GDP at some level,
Yeah.
but the stickier the revenue, the bigger the moat, the less correlation. Now, private equity also does benefit. We have to be very intellectually honest. It doesn't mark to market every day.
Yeah.
It doesn't mark to market every week. A lot of stuff now marks to market once a month, but even then, you don't have as much vol because of the fact that you don't have that just daily pricing. And
Mhm.
there's so many businesses that everybody watching this watched drop by 30% or 40% in value in about 2 weeks, that the business value actually did not drop by that. But
Right.
enough emotion was there. And, we have an adage as a firm, sell when you can, not when you have to, because stocks always go down faster than they go up.
Yes.
It's just fear is a bigger motivator than greed. But so when the client sees that kind of volatility when they pull out their phone or look on TV, that's a problem for the advisor.
Yeah.
It's hard to keep that emotion out of the equation. Whereas if they look at it and say, okay, well, last quarter I was up 2, or I was down 1, or I was up 3, it's a lot easier conversation. That doesn't mean you do everything in alts. It doesn't mean that you do only private equity. But if you have private credit that is benefiting from higher interest rates,
Yeah.
and then you have private equity that benefits from lower interest rates, now all of a sudden you have more diversification, less correlation, and you get much further to the left, as we talked about from MPT.
Yeah, I love it. It's a great example, Christopher. And one thing with private equity, and you did a great job of breaking in the buckets. It's such a big space now, right? I say private equity or alternatives, and I'm kind of doing a disservice to our audience because it can mean so much now, right? You have secondaries and all this stuff that we could have a whole podcast on by itself. So great example there. And how they're uncorrelated. Let's talk. You brought up the NFL and professional sports. You and your team recently purchased a stake in the Buffalo Bills, which is very fun. Just let's hope they beat the Chiefs here soon. I'm kind of tired of the Chiefs. Yeah, what was your thought process? I think you kind of just described it, but what was your thought process in owning? And it doesn't have to be the NFL team, any sports team through private measures.
So the first thing I will say is that we have a great partner at Arctos, who is one of the 4 firms that was approved to be able to buy teams in the NFL. So our partnership with Arctos allowed us to get the position with the Buffalo Bills. They've been great partners for us across all of the major sports assets that we have. We have about 30 different firms that we own
Okay.
positions in now, and all of them come back to the same theme. And I mentioned at the very beginning, we're a very thematic firm. Find the theme, find the best risk reward, find the best way to profit from that specific theme. In this case, it's all about cord cutting. And most people inherently go, well, of course, cord cutting is obvious. Everybody's going, not everybody, but large waves of people are going from broadcast or cable to streaming services. Well, that means if you cannot reach your audience as an advertiser in the way that you used to by just buying a commercial on Friends or whatever, well, then from there, you're in a position where it's tough to reach them except for with micro-targeting and social media. So a fun statistic for you. In 2005, 15 of the top watched programs, live events in the United States, were sports, 15 out of 100. In 2023, 97 of the top 100 were sports. That shows the dramatic shift away from broadcasting cable to streaming services.
Yep.
Why would you watch a commercial if you're not watching a live event? There's no reason to. So as a result, you've seen this increase in prices that you can demand for a commercial, whether it be a Super Bowl commercial or any other kind of advertising in the space. The other thing that we were really drawn to is what I referred to earlier. You own your piece of the league, which gives you such predictable revenue. For most of these teams, again, North America specifically right now, you're talking about 50 to 70% of your revenue is recurring. It's not a software company, but it kind of feels like a software company as far as the predictability of it. Now, outside of the US, it's a very different animal in that it's much more about a specific brand. We own a piece with Arctos of Liverpool, as an example, and Paris Saint-Germain and Aston Martin's Formula One team. Well, those assets don't get the same beneficial protections from the leagues themselves like they do here, but it is definitely still a great business. Anybody who's ever been to France knows how big Paris Saint-Germain is, and anybody who watches Formula One obviously knows about the Aston Martin team. But if you really boiled it down of why 85% of our investments have been in North America, I like buying legal monopolies. It's good to own those. Private equity was not allowed to even do this until basically 2018. So this is a new phenomenon. That's why people are hearing a lot more about it. And we were one of the first movers because of our theme about the change in consumer behavior and cord cutting.
Yeah, it's interesting. And I think too, it goes back to what you said earlier about what's in it for a financial advisor. And I think this really, when we talk about times of crisis or chaos, one of the hardest conversations a financial advisor has to do is keep that investor, keep their client invested in the plan. You invest in private equity or a private investment, it's a long-term investment, right? Then also you invest in sports, all of a sudden you got more emotion tied to it and something, it's something that you're going to probably want to invest in longer term versus the short term.
It's something that people really enjoy. People hear this and actually get really surprised. I'm not that big of a sports fan. I played football in college. I played golf in college, and ultimately I do enjoy sports as an athlete. I actually don't watch sports hardly ever, just kind of too busy. But it's something that even I pay attention
Yeah.
when the Los Angeles Dodgers are in the World Series, and I actually, along with our partners, own a piece of the LA Dodgers. So now all of a sudden, I'm more emotionally attached. I'm more involved. And it's fun to be able to do that. I mean, people love owning Apple stock if they're a big Apple customer. It's
Yeah.
very good to do that. Same is true in the private asset world. Just it's typically not as easy to do as it is in the world of sports.
Yeah. Yeah, it's interesting. We have a family member who had some money and it was she was a child at the time and wanted to learn about investing. I said, well, invest in Disney. She loved Disney, right? And she had an attachment to Disney, and she ended up going to Disneyland and was walking around saying she owns Disney, all right, to everyone. So, but yeah, you have that emotional connection. It makes the investment more fun. Years ago, being from Wisconsin, it was like the Green Bay Packers. Is for the longest time period, that's the only thing that you could really. It's about Boston Celtics, I believe, for a while, but that you could actually buy a share in. I often thought it was weird because you don't get any benefits for owning the a share in the Green Bay Packers, but now you can, and now you actually have a financial benefit to it. So
That's
at least,
correct. And it is interesting. Most people don't make the connection. The word fans is actually a root of the word fanatics.
yes.
So, everybody knows how fanatical everybody in Green Bay is, or most people in Green Bay are about the Packers. And it just shows the longevity generation to generation. That also makes for a very good business model when you have fans that literally, and I'm not kidding when I say this, they want to have their ashes sprinkled on your field because it's that emotional for them. That's a really good business when your fans are that loyal, your customers are that loyal to you.
You're exactly correct. And we've talked a lot about the big, NFL or the bigger leagues. How about, maybe those smaller leagues? Are there some good investment opportunities you feel in some of these small, maybe it's a WNBA or, something like that that is really coming up and coming. Are we still at the early stages of this?
I think we are. And, when you start looking at the opportunity set, it's like anything else, more risk, more reward. We own stakes in WNBA teams. We own stakes in Major League Soccer and women's soccer here in the United States, as well as football or, soccer around the world. But it's definitely more of a risk reward that you got to be comfortable with. But obviously, you're going to get paid really, really well if you're right. And based on a lot of the league protections and the league designs, it's not as risky as a lot of other things that have the same kind of upside. And so it's a very interesting area. Like anything else, you have to size it correctly in the portfolio and make sure that you have the core be the safer, the larger cap, if you will. And then obviously you can have some small cap and some emerging markets that certainly would be defined by some of those leagues we just talked about.
Yeah, fantastic. Last thing, we talked, within the private space, what's one sector that maybe you believe provides a great opportunity outside of sports, moving forward? Is there a sector that you really think it provides a great risk return trade-off?
So I'm going to give you two actually to
Okay.
your question because the entire reason we're having this conversation is one of them, and that is the growth of private markets. So as you get more and more money flowing to the private markets, very soon 401k plans having access to private markets, there's just going to be enormous dollars flowing to the space. For us, the best risk reward was to own the firms managing that money. And obviously, any financial advisor understands the economic leverage that you get, operating leverage that you get from being able to raise bigger and bigger dollars. You don't have to have 10 times as much people to manage 10 times as much money. And so naturally, that gives us an enormous edge. And we were one of the very first large allocators to the space. We now own over 95 different private asset management firms. Most of the audience has heard of, at least 50 to 70 of those firms that they know as household names. The second area that I would focus on is energy. I live in Houston, Texas. I can tell you, I had breakfast this morning, literally, with a gentleman that's lifelong Houstonian who's not in the energy business, but has made a lot of money in the energy business over time as an investor. And he's an investor of ours. And we said, basically, this is the best time to buy energy that we have seen in 40 plus years. And that is not an exaggeration. It is just the reality that the capital has left the space for reasons that people have the right to invest in what they want. But if people leave, traditional energy because they don't want to invest in it anymore, it leaves a void. And what that means is the prices become so inexpensive for those that are willing to invest in it. We're buying things at an average of 3.5 times cash flow right now. So some of them have a 25% cash on cash yield.
Yeah.
Now, obviously, there's more risk there than there would be in something like GP Stakes, where you own the private asset management firm. But the upside is also significantly better. But I will tell you, it is one of the most interesting times in my lifetime, in 35-year career, to be able to be an investor in energy and to make sure everybody understands we're for all energy. We're against all poverty, which means we're going to need all of the above: traditional energy, transitional energy, everything, in order to meet this enormous amount of demand growth we're going to see over the next couple of decades. Here's one statistic that illustrates my point, though. Historically, for every barrel of oil that we have produced, we have found another barrel. Okay, it's logical. That's how you keep equilibrium in the marketplace. So far this decade, for every 1 barrel of oil that we have produced, we have found 1/6 of a barrel. 1/6. Well, it doesn't take a rocket scientist to figure out, if you don't keep producing, and by the way, you can't just turn a spigot, these things come on. It's not Beverly Hills Billies where you shoot in the backyard and it comes up. It literally takes a long time to turn this production on, which means you're going to have a supply shock. And that's a problem for the economy. And it's something that obviously is an opportunity as an investor, but we've never seen that in the history of the oil and gas arena.
I agree with you completely, Christopher, in that, it's polarizing, that energy conversation, but it should all work together, right? Just not traditional, just not solar, or wherever you get your energy. You got to work on it together. I often talk about active versus passive. It shouldn't be a disagreement. We can all work together, right? Playing the same sandbox there. And I love the talk about alternatives and 401ks, and it goes back to the importance of your book, The Holy Grail of Investing, because there's a prime example of, you've got participants of 401ks who may have opportunities to invest in alternatives that need to learn about it.
Well, it's a great opportunity for investment advisors to truly differentiate themselves by understanding more about subject matter that their competitors don't. And one of the things that, obviously it probably resonates with the audience is that because I was a financial advisor before I started the firm to be purely an investor, we understand what it's like to run a business that's a financial advisory practice, if you will. And so much of what we do is to try to position the advisor to be successful with their investors. And one of the things that we help people do is figure out how to differentiate and how to not just be giving, okay, I give better service, which everybody says, some people do, but everybody says it, or a race to the bottom on fees, which nobody wants to do. So there has to be something that allows an advisor to stand out compared to everybody else. And alternatives and knowledge in this area can absolutely be that. And obviously, we'd be happy to help any way we can.
Christopher, great way to wrap it all up. Such great information. really fun conversation. Thank you. It was an honor to have you on. If there are any advisors out there looking for more information, where can they get it about CAZ Investments?
So best place is our website, www.cazinvestments.com, CAZ, C-A-Z investments.com. We got a lot of information there, a lot of educational material that you can use to give to your clients as well. And ultimately, just let us know how we can help you, because it literally is a way that we describe ourselves. Is our job is to help investment advisors grow their business. And we've done it over and over and over. And obviously, we'd be happy to talk with anyone that would like to have that conversation.
Awesome. Thank you so much, Christopher, for taking the time to talk to us about alternatives. Really fascinating stuff. And thank you so much for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel. Lastly, please follow us on the Zephyr LinkedIn page to learn more about Zephyr. Thank you and have a great rest of your week.